The European and Nordic financial services sector has been very resilient over the last couple of years, despite some very notable challenges. But the outlook still remains highly uncertain, and banking supervisors are really entering 2024 in a state of high alert. The resilience of banks will be put to test in this very difficult operating environment. We expect inflation to stay above target for the remainder of the year. We also expect to continue to feel the long-tail impact of rising interest rates over the last couple of years. Are you ready for it? Welcome, everyone. My name is Linda Hedqvist.
And I'm Simon Brennan. Linda and I lead the Nordics team within Deloitte's Centre for Regulatory Strategy. We're really happy to welcome you today to our webinar on the outlook for financial services in 2024. Our recently published report looks at the key regulatory trends, what firms should do about them and how they can really get ahead and anticipate the impact on their business.
And this morning, we will be helping you make sense of some of the major themes in our regulatory outlook report. And we're very delighted to be joined today by an excellent panel of Deloitte colleagues and also market practitioners that are each dialing in from different Nordic countries.
We're going to cover 4 topics today: current market trends, credit risk, sustainable finance, and operational resilience and AI regulation. That's a packed agenda. We've got about 20 minutes for each section. Linda and I will be trying to keep our panelists on track, and we'll make sure that we wrap up on schedule.
We're also hoping that this morning's session will be very interactive. Please do submit questions. There is an Ask a Question button that you will see on your screen. Simon and I will have the questions come through to us on the screen in front of us, so we'll try to answer them as they come along. If we don't have time to answer all of them, we will follow up after this webinar. So without further ado, let's kick off. So the first topic that we'll discuss this morning is current market trends and the broader market environment. And the last couple of years have been very difficult for financial services firms. 2024 could be just as challenging. Banks are going to continue to face economic uncertainty in the short term, at least. And in the longer term, they will face a couple of structural challenges driven by geopolitical tension, climate change, of course, and also technological innovation. And these challenges will shape the regulatory landscape, but also the regulatory agenda in many years to come. So with that, I'm very excited to introduce our first expert panelists on this topic. First up, we have Elisabeth Wernemann. She leads Deloitte's Risk Advisory Financial Services practice in the Nordics. Second, I'm also very pleased to welcome Sverre Danielsen. Sverre is a lead partner for Deloitte's financial services industry in the Nordics. Elisabeth and Sverre, are you with me?
We're here.
So very good to have you both. Sverre, if I can turn to you first. Day to day, I know that you're working really closely to firms in Norway, but also across the Nordics. How are banks in the region actually faring? And what do you hear from people on the ground?
No, thank you for that, Linda. It's an interesting question. I think if you look into the overarching financial services across Europe, globally for that matter, you would see that the Nordic banks in particular are doing exceptionally well. It's strong performance. We are looking at cost-income ratios on the high 30s and the low 40s, which when we present that to our colleagues across Deloitte and to other companies within professional services in financial services, you would see that those numbers are sky high. So those are great numbers coming in. That also means, like, if you listen to the people on the ground, they've actually used these last 2-3 years to actually invest heavily in technology, invest heavily in regulatory transformational programs like we are to be discussing today. So all in all, they are going strong.
Thank you, Sverre. So how is the geopolitical environment actually affecting Nordic banks and financial services firms?
They are affected in pretty much the same way as we see across Europe when it comes to geopolitical risks. So you would see the same risks that has heightened attention, like cyber risk, You would see sustainability risk coming in from the heightened tension on climate change. And of course, you would see some trade agreements being radically different than what they were before the tension raised across Europe in terms of the wars, both in the Middle East and, of course, Ukraine. So they are faced in the same manner in the geopolitical space. I would also say that it's been one question that has been on everyone's lips across the Nordic financial services sector, and that has been what really defines a minimum viable company or a minimum viable bank for the banking sector. And it's not an easily answered question, is it? But it basically relies on the companies to have a certain amount or level of resilience. And I think that's the key in how to face the geopolitical risks as well. And you would see the regulators focusing heavily on that resilience aspect. They want to see transparent and sustainable processes. They want to see sustainable and transparent business models and operating models coming forward. And the very notation for that is that the regulators heavily trust that a resilient bank, a resilient insurance company, a resilient company for that matter, will bounce back better from a crisis, manage a crisis in a better way than companies that do not, share that sense of resilience in their business operating models.
That's fascinating, Sverre. Thank you very much. Elisabeth, if I may bring you into the discussion here, from your perspective, what do you expect to be the biggest challenges for banks in the Nordic region in the year ahead?
So from a regulated perspective, and if I broaden the topic somewhat, I think that not only banks, but financial institutions in general will have a fairly heavy regulatory burden. A couple of years back, we talked about the regulatory tsunami that was supposed to end somewhere around now, and we're expecting then to have 10 years of supervision. But what has actually happened is that some of the risks that were referred to as geopolitical and just the heightened threat landscape from the outside has accelerated also some of the regulations that we see on the agenda now. When we look into what then is a common denominator for all these firms, I would call out data governance, data resilience, data lineage, and all the various topics, because to have reliable data is kind of the core foundation for any firm. In addition to that, I honestly see a bit of a difficulty with the type of regulations that are coming to have the ability to implement them all at once. And there it is important for the companies to be able to work with their resources in a smart way and to really have a good understanding on what the regulations are about, so that they can, first of all, cross-pollinate different teams working with the same theme but with different regulations, so that you don't build alternative solutions that don't match up in design. But also, I would say that it's important to make sure that you make best use of your resources. And to be able to do that, you need to have a really good understanding of the business impact. What is truly important for you as a financial institution, and not get too caught up in details early on.
Thank you, Elisabeth. Sverre, do you have anything to add to that in terms of what, building on what Elisabeth has said around challenges, around data and so on in the year ahead? Anything to add from your perspective?
Yeah, I think what Elisabeth just mentioned makes perfect sense, but I think it's also worth mentioning that what we are seeing in terms of the regulatory transformational programs like DORA, like CSRD, like the IA Act coming up, it's still hits some of those processes that we have been discussing with our clients and with you for several years, that you and the market themselves deem as somewhat suboptimal. And I think more and more companies across the Nordics now within our industry see some of these regulatory changes as opportunities to actually do this right and have the proper focus to get what they themselves perceive as suboptimal processes to be enhanced.
I mean, Sverre, maybe I can come in there. We've just had a question in about, okay, given all these challenges, what should banks actually prioritize? And I think it starts to build on what you've just said. So if you, yeah, what's top of the action list for firms in 2024?
Yeah, I think Elizabeth covered some of the main topics, but I think it's for a lot of us, it comes down to the approach. We definitely appreciate that there's a lot of different regulations coming in at the same time in a very, very rapid speed hitting the Nordics. And we see companies finding it somewhat challenging to deal with them all at once. And if you look into it, there's quite a few synergies across these different regulatory transformational programs, especially when it comes to the approach. A lot of the regulations like DORA, like AI Act and CRD, they go into the very processes and the self-awareness of how those processes work. And what we would like to see, at least I would love to see, that there's a far more discussion on how to really exploit those synergies across these working teams that are somewhat working in silos on some of these topics where they actually could do more good working together. I would in short say there are more commonalities on how to approach these regulatory challenges than there are differences.
Thank you, Sverre. I think we'd echo that from our experience here as well. So Elizabeth, if I may bring you back again. So we will obviously dive deeper into some of the regulatory issues later this morning. But before we do that, it would be really good to hear from you, from your perspective. What do you think are the top 2 things that are on the regulatory agenda for Nordic firms this year?
So if I answer that question slightly differently than just to throw a particular regulation up there, because that would be very individual to the firms. To some of the banks, to some of the insurance companies, all these regulations come into play and are of importance. But I think that if I worked at the bank, what I would try to do is to get a holistic mapping of what these regulations are trying to achieve and make sure to engage with the business to see, to make like a real business impact analysis. At the core foundation of every regulation and every supervisory activity, the business activities and the business strategy of the company is a driving factor for how much expectations there are. So I'm afraid that there is a lot of efforts put into areas that are less risky. And I think that a risk-based approach should be used for all regulation. With that said, obviously, I'm not saying that firms should not be compliant, but they should try to make sure what is the minimum level that you must adhere to and what is actually nice to have. Additionally, if you include the business, there's much more likelihood that that you will do this in a way that fits the business, so that you can implement regulation by design in the processes and not as a siloed activity on the side.
Yeah, thank you.
So maybe I can just squeeze in one last question. I think Elizabeth and Sverre, you've given quite a positive message in terms of synergies, alignment, regulation by design. But I mean, Sverre, one thing I come across a lot is regulatory fatigue. So is there any advice you give to a firm? How do you motivate your business in 2024 to just keep on at this and not get too tired?
No, it's a great question, Simon. I think we can build on what Elizabeth just said, that I think business and getting the business properly involved in this change program, because it is a change program, is extremely important. I think only then you will be able to see the opportunities that really resides within that change and that upcoming change. And I think the fatigue it could also be caused by the overwhelming landscape of regulatory change and not really having the chance or the time to sit down and exploit those synergies and see how we can actually change, well, I would say, or even modify or improve or enhance some of those processes like we discussed that have been seen as suboptimal. So this is a chance, this is an opportunity, and I think you should involve the business way earlier than what we currently see across the market in actually bridging that gap between the regulatory challenge and the huge opportunities that sits within it.
Thank you, Sverre. Regulation fatigue is a nice nice word that I'll take away from this discussion. So with that, we'll close the first topic. Thank you very much, Elizabeth. Thank you, Sverre, as well. Clearly, 2024 is going to be very challenging in many regards, but as Sverre just said, loads of opportunities there too for firms that are really able to navigate these obstacles in the year ahead. Elizabeth, we'll see you a little bit later. Thank you, Sverre. We're now going to move on to our next topic for the day, which is credit risk.
There's plenty for credit risk and credit risk modelling teams to think about in 2024. To date, despite the macroeconomic downturn that we've seen, there's been very little pass-through to some of the classic kind of credit deterioration that we'd have expected to see. And if we look beyond the macroeconomy, Basel regulation, market risk models, data are all on the agenda for the credit risk and modelling teams. To discuss this, I'm really pleased to have a panel of experts today. Tom Clifford leads Deloitte's Financial Services Risk and Regulation practice in the Nordics. Maria Englund is based in Finland and leads the Financial Risk Management Services team. She also works across Europe and the Nordics, helping clients with credit risk management, modelling and data analytics. I'm really pleased also to welcome Christian Christiansen, Executive Director with Islandi Bank, and an expert in credit risk and credit risk modelling. So really three people that I think are expertly placed to help us unpack this issue. Tom, Maria and Christian, welcome.
Thank you.
Thank you.
Christian, can I come to you first? So as I said just now, the economy has worsened, but we haven't really seen the kind of credit deterioration that we might have expected based on previous episodes. Is this the calm before the storm, or is something else happening?
Yeah, this is a very, very good question and a very curious case. So in fact, the banks in Iceland have been witnessing unusually low default rates, historically low default rates in an environment that normally would suggest otherwise. And it's not only default, it's also the early warning signs. So we don't see loans being passed through or increased for forbearance measures and so on. So there are at least two possible explanations for this. One is that we're of course coming out of the COVID-19 pandemic, where households cut down their spending and started to save, and companies have also been able maybe to push the inflation into the prices, and of course a lot of customers are still enjoying very low interest rates on fixed rate loans. So if this is the explanation, then we might be sitting on a ticking time bomb, because eventually the funds will run dry. But there is another explanation. It's also possible that after all these reforms being done in the last decade, with tightening origination standards and underwriting standards and lower levels of debt and so on, the credit portfolio, the asset quality of the credit portfolio was really good coming into this phase. And so that could be that the regulation actually has been helping us. I really hope that is the case. It better be. I mean, we've put a lot of effort into all this regulation, so I'm hoping that the banks are more resilient. And if this really turns out to be the case, then what you have to do is we have to go back to our models. We have calibrated our models based on long time series, and we might have to go back and sort of recalibrate the models based on this new reality. Yeah.
No, that's really interesting. I think the regulators will definitely be hoping for the second, but maybe worrying about the first case. I mean, Tom, from your perspective, you're on the ground across the region. What do you think? And if we are sitting on that ticking time bomb, are firms ready to weather a rise in delinquencies or defaults?
So, I mean, I think it's really fair reflections that, it's difficult to tell where we are. I think it's definitely true that there is a level of improved credit quality relative to before the last financial crisis. If you look at balance sheets across the region, that they haven't really grown the last 10, 15 years in terms of lending in aggregate, but there's been quite a lot that's moved to non-banks, private credit and alternative investments, where they've been providing some of the funding. And so you could argue that the banks are relatively well protected by the quality of their balance sheet. But I also have a nervousness. I have a nervousness that reminds me of when I was in credit risk in banking in 2004-05, where there were certain portfolios and pockets that started to look a little bit light in terms of credit controls, light in terms of underwriting criteria, or where asset collateral values were starting to drop. Commercial real estate is a really big topic here in the region. In the Nordic region, there is a lot of concern around that. You're starting to see certain nearer prime categories of customers starting to creep up in terms of the early warning indicators. So, I think there are some of those pockets where we'd be concerned. So what should banks do about it? Well, what we think is that they should be, and what they are doing is they're starting to try and look for that latent credit risk. It might be lagged, it might still be to come through from COVID. And that needs to be seen somewhere in impairments, and we're seeing banks do that via their post-model adjustments and overlays where they can't see it in the data. But it also needs to consider the business impacts if those defaults and arrears come through. For example, are the debt collection capabilities and functions in place that they could manage an increase in demand for managing those difficult customer cases whilst looking after them and treating those customers fairly? I'm not certain that the Nordic banks are ready for that, because it's been such a long time since we've had such a period and incident. So that's an area where I think one could expect both management teams to look at it and also closer supervisory monitoring and regulation, because if the banks say there's nothing to see, and some of the external indicators suggest there might be, then those early credit warning indicators and those stress tests and those scenario analysis that the banks and regulators expect banks to use, they will be raised up the agenda and will become more prominent in how those tools are being used and expected to be used.
Thanks, Tom. And of course, all the changes we're seeing now to the Basel framework were partly driven out of the financial crisis and responding to that. Christian, I mean, Basel's still top of the agenda. I think it's hard to just keep saying Basel. What specifically are you focusing on in 2024?
So we are, of course, preparing for the Basel 3.1 that's supposed to take effect 1st of January 2025. We are in the unusual situation, maybe, that so here in Iceland, all the big banks are locally systematically important, but all using the standardized approach for credit risk, which is unusual. So we are not dealing with this problem of thinking about sort of the output floors and so on. So what we are doing now to prepare is we're making sure that we have the correct data, we can rely on our data, that the IT systems are up and running, that we have the right interpretation of the regulation, but also starting really to actively involve the first line, because it's so important for the first line to understand what's changing. They need to be able to price their loans differently based on different capital requirements. We also have to look at sort of our inventory of products. How do we build up our products? What products are we selling? Because I firmly believe it's much better to to sort of align the products with the regulation rather than just keep on lending and then trying to figure out in the end how to calculate the right capital requirement. So this is what we're dealing with. Also, of course, sustainability that I know will be discussed a lot later. What we are dealing with now in Iceland is almost like a warm-up exercise for the environmental risk, not climate risk, but so what we have here in Iceland is that there is a volcano threatening to erupt under a town called Grindavík. So this is a town of 4,000 inhabitants. They were all forced to flee in November, haven't been allowed to go back home. All the banks have offered general moratorium for households and small companies. Now the government is trying to set up some kind of a program to assist people with livelihood and housing and so on. But the banks will face some credit losses, that's for sure. Even though, the payment ability and the willingness to pay was quite high, this was a really good credit portfolio before this sudden eruption of volcanic activity. And this is something that we couldn't have incorporated into our models. So this is maybe one of the reasons for why maybe the standard approach is working better for us now, because this is definitely something that any PD models, we couldn't incorporate this into a PD model. So this is one of the things that we're really thinking about now.
Thank you, Christian. So we've actually received a question from the audience. So we were talking about regulation fatigue earlier, but there could also potentially be Basel fatigue at this point after several years in the making. So Tom, I'll ask you this question. So, practically, what is the best way to actually engage the business in implementing, the latest Basel changes, given this general fatigue and the wave of incoming requirements?
Yeah, that's a good question. So I would probably break it down into three parts. I think first of all, reminding as many stakeholders as possible in the bank, particularly at the executive level and the management levels, why Basel is there to create resilience in a balance sheet for the long term, and the thought and consideration that's gone into it, I think, is important. So really getting those skills and knowledge up is a priority at senior management level. I think the second part is on IRB. So those banks that have made the choice to use internal models will continue using them, separating out the repair work that's needed to maintain and ensure compliance with the Basel 3.1 implementation. They are clearly related. Clearly, there is an easier, simpler option when you are a standardized bank, which gives you some more opportunities, but you have two different sets of programs to run that. And so making sure that you are delivering on the IRB program and the remediation and understanding then the dependencies to your Basel 3.1 work and the uncertainties that creates with your business stakeholders. So being clear on what will be delivered and where there are risks, I think is critical to the success of engaging the business. And then finally, then explaining the value that will come out of it, or the value that happens if you are not compliant. There is a destruction in value. We've seen it in firms where they don't hit their IRB milestones, they don't hit Basel compliance, and that is a license to do business in the banking sector. So I think it's reminding the business of that and the importance to the institution.
Thank you, Tom.
So, Tom, Christian have both mentioned IRB and standardized models. So, Maria, maybe I can move to you at that point to think about model risk management. So in our report, we talk about model approval timelines and the increased regulatory focus on model documentation. I know that the regulators are expecting clear, concise, objective model documentation. So from what you see in the Nordic region, how are banks faring with that?
Thanks, Simon. We certainly do see these challenges that banks are facing in often lengthy, complex, and very technical model documentation. And we are starting to see actually some positive shifts towards increased investments and effort on developing model documentation and governance. And in doing so, banks will not only benefit from obviously achieving regulatory compliance and faster model approvals, but also there's opportunity for increased internal operational efficiencies as well. Now, a further challenge then for banks on this topic might be how to implement and operationalize those methodologies and frameworks. But again, clarity of structure will really help with this. I thought I might mention on kind of model risk management more broadly as well, a few trends in the Nordic region that we're seeing. We recently ran a model risk management survey, and there were some interesting findings, again, on Nordic banks. So firstly, it's looking like the scope of model risk policy does seem to be expanding further outside Pillar 1 and Pillar 2 financial risk models into areas such as ESG modeling, for example, a very hot topic, where we're seeing the focus very much on the E, so the environmental modeling environmental risk drivers. So that's leaving the S and the G, social and governance, requiring a little bit more attention from banks. Another emerging trend, as we've heard and as we will hear later today as well, is of course the use of artificial intelligence and machine learning techniques in modeling, albeit adoption on credit risk models within the Nordic banks seems to be fairly limited so far. These techniques, AI and ML modeling techniques, do seem to be here to stay, however. So it's important that banks navigate any risks associated with using these techniques and really proceed with caution and pay particular focus and attention to any implications of the upcoming EU Artificial Intelligence Act, including proposed penalties that puts forward. But I'm sure we'll hear more about that later today as well.
Yeah, I think it's really interesting how models pervade the organization now. We used to think quite narrowly about credit risk, operational risk, but obviously artificial intelligence and machine learning are broadening that. Can I ask you about data quality as well? Another topic that's been on the agenda for a long time. What's new perhaps is the ECB recently has expressed concern about banks' lack of progress on implementing BCBS 239. Given how long this has been around, can you unpack that a bit? What is it that banks need to do differently?
Thanks, Simon. Yeah, happy to. So the ECB has indeed expressed concern over the lack of progress on banks' BCBS 239 programs, stating that not a single principle has been fully implemented across all banks. Some reasons for this could be around insufficient funding for implementation projects, limited scope of programs, as well as insufficient attention of executive boards and senior management. So bank boards should really be prioritizing and intensifying their oversight of data governance. Interestingly as well, the ECB's recommendation to supervisors has been to consider not only follow-up letters or mandated reviews, but also more forceful measures such as capital add-ons and restrictions on business activities to address these lacks and gaps in risk data aggregation and reporting capabilities. So indeed, it seems like the messaging is now shifting towards use of these more forceful measures to ensure banks achieve compliance with the regulatory requirements. On data quality, definitely a hot topic, and Elizabeth already mentioned this earlier this morning as well. It is really important for banks to promote a culture of ownership of data quality throughout the organization, as well as defining and embracing data quality as a cornerstone of digitalization projects. So data quality obviously continues to be an area of supervisory focus, and it's important for banks to get it right. You know, whether you're a standardized bank thinking about applying for permission to use internal ratings-based approach, a lender modeling ESG risk drivers, or banks transitioning to leveraging more kind of new tools and technologies in their credit risk modeling or data gathering processes. And really kind of just to highlight also that end-to-end data quality in banks' end-to-end data flows. So to ensure the quality of customer data through origination all the way to reporting so that banks can be comfortable with, say, their LTVs being right through the end-to-end credit data lifecycle.
Great, thanks. A lot to think about there. Thank you, Maria. Christian, maybe I can just turn to you for the kind of the practitioner perspective on that. And also just interested, given the longevity of data as an issue, how are you continuing to mobilize investment into tackling the data challenges?
Yeah, so this has not been easy. I mean, so the principles stated in BCSB 239 are all pretty good. I don't think anyone is against any of the principles. So we are really trying to achieve them, but it's just very hard. But looking back 10 years, we see that, you know, in the beginning, it was maybe mostly sort of the risk management division that was focusing on this. But over the last few years, we see, you know, the other divisions in the bank and the business even realizing the value of having high quality data and sort of understanding how we can use good data as a force for good. And that certainly helps. And in our bank, we recently updated the official strategy to include data as one of the cornerstones. So with the harnessing data and using data-driven decisions is sort of a key theme for us. But also at the same time, I think, you know, these principles, this is not something you can just do and then be done with it. This is almost like in gardening. You have to continuously work on this. You can't just, you know, plant and weed once and then keep on harvesting for years to come. That's not how it works, because, you know, the IT systems are changing, the regulation is changing, the people are changing, our products are changing. So we continuously have to keep on working on this. So even though we're trying and pushing, I think this will be, you know, this is not something that will just be done. It's not like that.
Brilliant. A really good, I really like the gardening analogy. We're close to the end of this session, but Tom, perhaps I can go to you for the last word. We've covered a lot of ground, but is there anything else within this kind of sphere of risk that you would put on banks' agendas for 2024?
Yeah, I mean, if I think about financial resilience in general, you know, we've just had in 2023, we've had a couple of major bank incidents with Credit Suisse and Silicon Valley Bank, which regulators have learned a lot from. We comment on it in our outlook, and I think that will lead to a real focus on some of liquidity risk management and how that might work and behave under stress. We're also seeing the link to that between that and recovery and resolution regulations, and ensuring that banks are resolvable in difficult situations, and they have clear and tangible plans in place that they've run and they've practiced to be actually operational. So I think there'll be something around the liquidity risk management, probably something around recovery and resolution, and then finally a positive view maybe is the opportunities that come out of some of the new technology and generative AI. We're already seeing banks experimenting with, and all financial institutions experimenting with Gen AI and how that can be used to enhance risk management. And I think the risk management of the future is an exciting place. And that's, you know, maybe less regulation and maybe some more risk management would be a good place to get to.
Thanks very much, Tom. Less regulation, maybe. Let's see. With that, I'd like to thank our panel, Tom, Maria, and Christian. That was really interesting discussion. I think you've helped bring that topic to life, and I hope in a way that helps our audience think about what to do. Let's move on now to the next topic and sustainability. So sustainability is just another topic, but the context is obviously really important. The sustainability transition, especially in the EU, is transforming the economy, both and the financial services system. And so for the banks, that means new opportunities, new challenges. And within that transformation, regulation is absolutely critical. So I'm really delighted this morning to have the chance to discuss this and to welcome our three panelists. Gunnar Magnuson is Head of Sustainability and Climate for Deloitte in Iceland. Gareth Greenwood leads the Nordic Sustainable Finance team out of Stockholm. And I'm also really pleased to welcome our second guest, Liam Flanagan, a senior sustainability expert at DNB in Norway, and who, amongst many other things, helped lead the team that delivered DNB's first transition plan. So Gunnar, Gareth and Liam, welcome. Gunnar, perhaps I can go to you first. So I've heard noise in the market. I've read in the press kind of a concern that maybe sustainability topics are being deprioritized by policymakers. And certainly we've just heard in the previous two sessions, banks have a lot to think about. Are you seeing that on the ground? Where's sustainability in the list of issues for people?
Yeah, it's definitely something, we're picking up on that, there are obviously other priorities, influencing policymakers and regulators. And we have big elections in this year coming up, both in the US, but also in Europe. And the outcome of that will be, will probably have some impact on some of these sustainability regulations and the reforms that are required. Also, geopolitics. Obviously, we have wars in Ukraine and Gaza, and I think this is something that obviously is as high on the priority list for both the economies but also policymakers. So definitely something to be aware of. But I think if we look at the drivers for sustainability, obviously has been regulatory change, and like you mentioned, EU has been probably the ones leading on that effort, and I think there's very limited risk of reversal. That would have countries or regions moving back on this. I think it's more of a question of whether the pace or the speed of the implementation. So we already have in place, the CSRD, taxonomy, SFRD, and more regulation coming online as well. So I think it's more than a question of in terms of supervision and enforcement. How vocal will, for example, central banks or financial supervisors be on these topics, and aligning with possibly political messages. So and then for the banks and the financial services companies, I think it's something to be aware of. There is some uncertainty now, at least in the short term, regarding this. But I think our experience is it's not slowing down implementation within the organizations themselves. So, but then like I say, it's a fast moving world. So obviously people are aware of these things. But we haven't seen much that there is backtracking or any way like that. So.
Oh, fantastic. And that certainly aligns with my experience. With that in mind, then, what are the top priorities for Nordic regulators on sustainability in the year ahead?
Yeah, I think it's like for now, what we're seeing really coming very fast is obviously the Corporate Sustainability Reporting Directive now coming into play this year in the EU, and obviously the Nordics are exposed to that. So I think reporting is going to be very important for this year. Setting up the necessary structures, the procedures, also the systems. Most of the bigger companies have done these double materiality assessments, at least the first ones. They're involved in gap analysis now, finding where do we need to improve on, where are both in terms of then the data gaps, but also in terms of the processes that are supposed to capture them. So, and then also on that front, we also have like taxonomy information that the banks and the financial players need to disclose. So on top of that, and then there's also this combination between, obviously the corporates are exposed to these regulations at the same time as the financials. So there'll also be some, I think, let's say, thinking about that, preparing for once for example, the banks receive this information from corporations through the new European sustainability reporting standard. How are they going to process this information, and how do then they take this information into their models and such? So I think that's a lot of focus area. Also, in terms of thematic areas, obviously climate and transition to net zero has been high on the agenda for banks in the region and other players. But I think areas such as nature is coming quite fast now. We see that like the TNFD recommendations, many are looking into that now. How do we how do they incorporate that into their operations? But also other factors such as social, and I think like human rights due diligence and areas such as that. I think that would be gathering pace pretty fast too. And maybe one last thing to mention there also we're picking up is the governance issue. Is that how do we now adapt our organization based on these new requirements? And one theme we're seeing there is that in terms of sustainability reporting, that function is often being now moved to the finance function, so that we're having more kind of a spread within the organizations, more people kind of picking up the slack, so to speak. So the CFO office now taking more and more responsibility on the sustainability information, obviously because of one of the concerns is that this will now be assured by the auditor. So I think these are some of the themes that we're seeing, and I think it's going to be a busy year for financial institutions in terms of sustainability.
Thanks, Gunnar. That tees up really well the discussion as we're going to drill down into some of those topics. But Liam, perhaps I can just come to you first before we drill down. And Gunnar's mentioned all those different things. From your perspective, then, what are the challenges that Nordic banks face in terms of actually meeting these regulatory expectations?
Yeah, certainly, and I think he has hit the nail on the head there. We see two challenges that we're certainly familiar with that are probably the most pressing or key to delivering on the upcoming regulatory expectations, and those center around data and competence. And not to say that the competence isn't there, but ensuring that we get the intersection of competence related to financial services as a sector, related to upcoming regulatory interpreting upcoming regulatory obligations, and ensuring that that can be implemented successfully, as well as the background in sustainability. Making sure that the intersection of those three topics comes together is incredibly valuable, and that's more what I mean by the reference to competence. On the data side, I think it's the ongoing hunt for consistent access to high quality data that is to a lesser degree based on assumptions and estimates that we've seen historically, that enables comparison and is also at the same time available at the appropriate level of granularity, making it fit for purpose for the range of needs, some of which were just touched on. I think those two, as well as several others, are amplified or compounded by another point that was touched on, which is the fact that we're seeing sustainability or subcomponents of that, climate most recently, nature upcoming. We're seeing those subcomponents and sustainability as a whole being embedded in a whole host of upcoming regulations. So both the volume as well as the different reporting obligations that stem from that and the timing of when they'll hit all sort of amplify the existing challenges or challenges that we've been perhaps more familiar with historically.
So Liam, while we have you there, we have received a question from the audience. So you, as Simon introduced you in the beginning, you've been working on DNB's transition plan. So one question that has come through the audience is, what are some of the key ingredients to an effective transition plan from your perspective?
Absolutely, yeah. DNB launched the transition plan in October last year, and in terms of effective ingredients, I think there are a couple that stand out. One, first and foremost, is credibility, both in reference to upcoming regulatory obligations that we touched on, but it also being based off of existing frameworks, incredible frameworks out there in the market, like GFANZ or the Glasgow Financial Alliance for Net Zero, or in the UK, the Transition Plan Task Force, just to name a few. So based off of an existing and recognized framework with a long-term ambition towards 2050, underpinned by credible interim targets in 2030, credible meaning, as I say it now, being science-based and aligned where possible to a 1.5 degree temperature outcome. So those elements of credibility certainly need to be there. But again, because transition is such a broad topic, really the plan needs to be anchored across the organization. So everything from the board and group management through the relevant risk functions, through to those individuals and teams with the in-depth understanding of the exposures and activities that the bank undertakes, through to the support areas that are responsible for operationalizing a large chunk of this.
Then following credibility and having it anchored, I think having an in-depth understanding of the contents of the existing portfolios, the exposures, the activities that we undertake, and ensuring that we take a realistic approach to and a transparent approach to describing what's within our control as a financial institution and things that we are dependent on, or some dependencies or dilemmas that we face, and being quite clear to the largest extent possible on what those are and how they impact our ability to achieve the targets. And then lastly, a clear definition of roles and responsibilities related to the transition plan, and how that is implemented, followed up, and embedded in the underlying processes that are necessary to manage the progress towards achieving those targets in the future. And understanding that it is a living document. This is a rapidly evolving topic and very much needs to be maintained and updated over time.
Thank you, Liam. Very helpful.
I mean, Gunnar, maybe I can come to you just there, because I think talking about transition planning, one thing that strikes me is that on the one hand, banks are being encouraged to be bold, both bold in their transition ambitions, but then in the transition finance they're providing. At the same time, regulators are emphasizing about the importance of good risk management, keeping within your risk appetite framework. Of course, transition is risky and uncertain. So is there a tension between those different factors?
Yeah, I think it's definitely, for me, I see it as a short-term versus a medium, long-term scenario. Obviously, in the short term, there are possibly some, let's say, challenges. We have obviously big sectors, heavy industry, transport, shipping, fossil fuel, which will have a hard time, or it will take some time for them to find their credible transition plans, because we're also waiting for technology, from the corporate side to pick up, and biofuels and renewable energy and such. So I think, in the short term, yeah, there are probably some challenges in terms of that. But I think if you look at the broader framework, and just referring to what Liam was discussing there, once you've kind of integrated this concept into your institutional framework, and you start assessing risks in your portfolio, you look at it obviously from a physical and transition risk, and I think that's where you really see the benefits of having a transition plan, because it's going to lower your risk. So I think maybe in the medium term, definitely there's complementarity between these two things, because if you don't have a climate risk approach to this, credible one, then you might end up with stranded assets. You might end up with part of your portfolio being under pressure. So I think there's definitely a convergence there. But then obviously it depends on also the sectors that the banks are involved with, and I think it will be interesting to see how fast the momentum for let's say greening the economy will be, and I think we're seeing a lot of initiatives coming through the EU now in terms of catalyzing businesses to build up transition plans, but I think it's a little bit unclear in the short term, but I think definitely the medium to long term, this is going to be I think fully complementary.
Thanks, Gunnar. I mean, Gareth, I'd like to pull you in there. We're talking about transition planning. Liam and Gunnar have both mentioned data, but specifically in terms of the credibility of transition planning, how important is data there?
Oh, thanks, Simon. And I guess it would come as no surprise for me to say, well, it's critical. And I think if I refer back to some of the comments that Liam was making of what are the components of a transition plan, so we look at scenarios, we look at science-based targets, we need to look at our own commitments on reduction targets. We look at metrics. All of these are very data intensive. And when we look at the transition plans, they need to be built on that very solid data foundation. And I think that the key word, and we've mentioned it quite a few times, is credible. So again, when we look at what makes a transition plan credible, we look at the metrics and we look at the data, and we want to see that it's quantifiable. It can be verified. So these are quite fundamental in building the transition plans. And it does take us a little bit now into these topics and discussions around data quality. So I think some of my colleagues have mentioned that already in other contexts, but data quality is it's a key activity, it's a key focus as we look at how we develop the ESG frameworks within financial services over the coming years.
And of course, I'm going to touch on this in his list of topics, but corporate sustainability reporting starts, well, as firms are doing it this year, they'll make their first publications next year. That's going to transform the landscape for firms. What should banks be doing about that?
Yeah, so I think we've seen the data landscape. It's been developing over a number of years, and I think actually we need to actually take a little bit of a step and look at what's happening in the corporate world. So if we look at I think again we talked about a regulatory tsunami that's hit financial services. Well, it's a very, very similar situation in the corporate world. We have new regulations that are coming in on buildings directives. We have regulations on energy efficiency, energy markets, land usage, circular economy and products, regulations on supply chain. So why is this relevant? Well, a lot of this is going to create new data. So we're going to see a lot more data points, a lot more material data points coming from the corporate world. And then I think you touched on it, CSRD. So CSRD, that's the game changer. So we'll now see, let's say we shift up a gear. So as we go through this year, we see the first wave of CSRD disclosures coming through. So within financial services, we'll get access to much more material data points. But I think also, and I think that this topic was raised earlier, CSRD is going to help us more with standardization. So we are going to actually we're going to have more comparability. We're going to see higher quality data, more comparable data points coming through in a verified standard. And if I just give one example, I think it's the data challenge it has existed, but we do see improvements already. If we look at climate disclosures, and I look at examples where I see some of the financed emissions disclosures that are using the PCAF framework, we already see steps and progress as the data quality scores, they're improving already. So I think we are on the right trajectory, but I think as we hit 24, 25, 26, this data journey is going to accelerate.
Thanks, Gareth. I mean, Liam, maybe just to turn to you again for the DNB, the practitioner perspective, how are you as a firm tackling the data sustainability challenge?
Yeah, happy to speak a little bit about that. And everything that was just said rings very true and feels very familiar. We've worked, of course, to improve the quality and accessibility of the data that we need and looking forward to future needs. But the most relevant step that we've taken to date has been the creation of what's called the ESG Data Hub, which is an internal and dedicated function responsible for managing all of the organization's ESG related data. One challenge with this, of course, as Gareth mentioned, was that this type of data hasn't, for very long, or historically been collected, hasn't to the extent that we might want it to be comparable. And as a result, we're navigating this new and developing data landscape as more and more information and data points become available. And CSRD is quite key in ensuring that happens in sort of a step change fashion going forward. But while there's a bit of a challenge with this new type of data or these new data points, there's also a large opportunity in that we're not so bound by the constraints, perhaps, of legacy systems and the fields that might exist within them. So the ESG Data Hub has been developed. It's comprised of individuals with a data background or data scientist or data specialist background, as well as those with an ESG specialist background to really bring those two competencies together. And it's been developed on a couple key principles, and first and foremost is being the single source of truth for ESG data within the organization and fulfilling the ESG data needs across the organization. But it's also been developed to be rapidly scalable and flexible in terms of the ability to add new fields as new data becomes available and amend existing fields. And as I mentioned, it's not built within a legacy system, so it also provides the ability to take this core ESG data and enrich it as necessary from fields pulling fields from both internal systems as well as external data points. And we expect this to, of course, be quite a key contributor to our ability to have a true understanding of how we're progressing towards some of the targets that we set in the transition plan, as well as to meeting our upcoming regulatory obligations, as well as informing to the strategic approach we take off the back of this. So for us, that's been the most recent key development that we continue to work with going forward.
Yeah, well, I think many people listening will be thinking that's a really good example to follow. So thanks, Liam. Gareth, just to wrap things up. So I think implicit in what we've all been talking about for the past few minutes is climate. That's where regulators are focused. But nature and environmental risk, I know, are becoming more important. How well positioned do you think Nordic banks are to tackle those risks in the year ahead?
Well, that's a good question, Simon. So I think let's look at it. So nature is important, and if we look at our region in the Nordics, we have a very, very high environmental footprint. So 50% of our land is covered with forest. We have industries that are hugely reliant on natural resources, agriculture in Denmark, fisheries in Norway, the forest and the pulp and paper industries that span across Norway, Sweden, Finland. So nature and nature risk and environment is key to our region. I think it's fair to say as well that the climate understanding of the climate risk and climate disclosures is more mature. But then 2023, I think, we saw significant developments. So we saw the launch of PBAF, so the Partnership for Biodiversity Accounting and Financials. We saw significant publications from NGFS, so their conceptual framework on how to understand nature risk. We saw detailed guidance from TNFD as well. So I think we now have some external frameworks that we can bring in. We can now utilize and use these more in the financial services industry. I think it is important that we need to understand. So we need to understand the planetary boundaries in our region, and I think 24 is going to be a key year for us to start to work with these new frameworks. Really, just begin to understand actually what is the how does environment and nature risk really kind of impact our financial services businesses and our clients.
Fantastic, a great note to end on. Thanks, Gareth. And Gareth, Gunnar, Liam, a really interesting discussion again. Thank you very much for joining us.
So there are two things that we actually haven't talked about yet this morning, but are two really important priorities in the Nordic region. So I'm talking about operational resilience and also artificial intelligence, so AI regulation. Operational resilience is one of the key priorities for Nordic firms in 2024, not least because there's only less than a year left to actually implement the DORA, so the EU's Digital Operational Resilience Act. The EU at the same time is also finalizing its AI Act with final rules to be agreed later this year. So although these two initiatives are in very different stages, so one is kind of being wrapped up and we're looking forward to final implementation. The other one is just seeing the light of the day. They're both very critical and they will require Nordic firms time and attention in 2024. So with that, I'm happy to welcome back Elisabeth Wernemann, who we heard from earlier. With us, we also have Stephanie Royce. She is Deloitte's Crisis and Resilience Practice Leader in the Nordics. So Elisabeth and Stephanie, welcome. So Stephanie, if I start with you, with only 1 year left, or actually less than a year left until final DORA implementation, how do you think that Nordic firms are actually doing in terms of progress?
So what doesn't make it easy for Nordic firms is, of course, the point that has been raised before is sort of that tsunami of regulation coming to them. Certainly into the resiliency space with not only DORA, but the Cyber Act, the AI Act. So you see that organizations, not only in the Nordics, but across Europe are struggling to be compliant with all the different regulation that's coming to them. But if you're looking specifically in the Nordic firms in relation to DORA, you see that the organizations are in different stages of their maturity in the implementation of the requirements. You see that most organizations have finished sort of the interpretation and ongoingly are looking into the RTSs that are coming. But they are refinishing their gap assessments, readiness assessments across the organization, and moving slowly into the planning of the interpretations, looking into methodology, for instance, to identify critical and important functions. But it's not an easy thing to do. So you see the different stages where banks are a little bit more mature in the progress than insurance companies or investment managers. So we hope that this information that we'll share with you today can help you take the next step in becoming DORA compliant.
Thank you, Stephanie. So, I mean, given the very limited time frame that's left, what do you think, or what areas do you think the Nordic firms should actually focus in on with the limited time that's left?
I think one of the key things to focus on is not to wait till the regulation is final, not to wait on every single step of the RTSs that is coming, but really making sure that as an organization start now, or if you haven't already started, take a sort of a top-down approach where you really make clear governance across your organization, a holistic approach. So it's not just IT focused, because DORA is not just IT focused. You really need to take it from also a resiliency angle, looking into your business continuity, looking into your third-party risk management. And if you take that clear governance, clear direction at an enterprise level for an organization, it can really help you with the right interpretation of the regulation, making the right plans for implementation. Taking not only into account your own organization, but really looking to your end-to-end ecosystem and really start working together with your third-party vendors to already be able to see if they are being critical. And if they're critical, how can they be compliant? Because it is so important in the light of DORA that you not only look into your own financial services firm, but look across your whole ecosystem. Next to that, I think one of the key things is start now already with the methodology you want to use. For instance, identify critical and important functions. Thinking about what are other areas that within your organization you already have. Because it's not new resiliency. You have already current capabilities available. Take them, use them, and just bring them to a higher level of operational resiliency. Because there are simple, small steps that you can take to already become compliant. Certainly taking a principle-based approach with that, as we just have less than 12 months to go, is an initial step.
Maybe, thanks, Stephanie. Maybe, Elizabeth, I can just ask you. So that, Stephanie's kind of mapped out what firms need to do, but in your experience, what are the most challenging issues that they face as they go on that implementation journey?
Well, first of all, obviously, I fully agree with Stephanie on the fact that this is going live in a year's time and you really need to step up the implementation pace. But I think that when you look at DORA, it is quite easy, and we've seen quite a few companies who kind of just puts it somewhere within IT, when really the regulation is about how resilient is the business. So from my perspective, I think that the one trap that companies might fall into is spending too much time on details and on, let's say, legal complications, and less on the actual business analysis of what is a critical service. How resilient are we? What impact would a failure have or a disruption have? And to be able to really focus on the important matters of actually being able to provide good services to your customers. So I think that the risk is that you fall into details and do not really get to the big ticket of proper resilience.
Thank you, Elizabeth. I think that that last point really resonates with me, at least. So, Stephanie, if I come back to you for a moment, operational resilience is obviously broader than just the DORA, even though all the everyone's focused on the DORA at the moment. In your view, what actually comes after the DORA?
And I think that's a really good question because it's not so much what's coming after the DORA, it's already what is going on now. It's not just DORA, you have also the Basel principles that are already there, but across the world there is so much regulation over the last few years coming on operational resiliency. As Elizabeth mentioned, really to make sure that financial services firms are able to be resilient in case of disruptions for their customers, to be able to continue the business and to be able to continue to deliver the services to your customers, as well as the whole ecosystem from a financial market perspective. So it's not so much as we had a few years ago, the discussion on not so much if you're going to be hit by a cyber attack, it's when. And the same goes if you look into resiliency. Currently, with the geopolitical environment that we're in, all the different disruptions coming also from a technology perspective, natural disasters, it's key to make sure that you as an organization put resiliency in total as operational resiliency front and center of your license to operate as an organization. To really make sure that you are able to prevent, but also to really be able to respond, adapt, and recover from any disruption that could happen. Not just from a technology perspective that DORA is only focusing on, but from a whole organizational resiliency perspective. So my key next step will be make sure that when you're looking to DORA, take that holistic approach, take that further next steps to make sure that your organization will be able to provide their services to the end customer and have really that firm viability that operational resilience stands for.
Thank you, Stephanie. And that's really helpful, I'm sure, for the people in our audience as they do the final stretch of DORA implementation. So if we turn to AI regulation for a moment, which is clearly the other big priority that we're discussing right now. So Elizabeth, if I turn to you first, what are the Nordic regulators' biggest concerns when it comes to the use of AI?
Well, I guess it's the same suspects as they have in any other, with any other risks. Do you have proper risk management in the company? Do you have the ability to show who is responsible and who is accountable for different matters? I think currently also the regulator is, or the supervisory functions would be a bit, they would actually spend some time on thinking on how can they monitor this, because they might need some added capabilities and new frameworks for that as well. But I think that in essence, I mean, I am so pro artificial intelligence. I think it is really, really good. But it does have a very sort of similar risk as models in general. That if you don't understand the data that you're using, there is a risk that you will come to the wrong conclusions on the basis of bad data. So the whole concept of model risk is a good one to have in the back of your head when you engage in using these types of tools and solutions.
Thank you, Elizabeth. And you know, for Nordic firms, given the incoming EU AI Act that we'll see finalized this year, what do you think Nordic firms can actually do at the moment to prepare for that coming?
Well, given that many firms are currently engaging in using AI as such, I don't think they should wait just because the regulation from a European perspective is going to be a few years away. Because if you look at the current regulations about governance and risk management, you are expected to cover those and to have a risk management system that really captures all risks. So I think that one of the most important things is to engage in ensuring that whatever risks emerges from the use of AI for your particular business, that those are also monitored and captured through your risk management system and your model risk framework. But then I think that it's also extremely important to understand that the use of AI in a business will be very pervasive, and it will touch a lot of people who might not be model risk experts. So there's also some risk cultural work to do with education and making sure that the user understands the importance of managing the risks that could occur on a consequence of using AI.
Thanks, Elizabeth. I think we've got one time just to squeeze in one last question. Someone's asked, I mean, you've emphasized that AI is another risk and firms know how to manage the risk. I mean, is there anything you'd pull out in terms of how it's different from other technology-related risks?
Well, the first point is just the broad use, that you will have people in all pieces of the business that could be subjected to using AI, and sometimes without even knowing it. It will creep in through the outsourcing solutions, through different types of software. So it's going to be very pervasive throughout the business. And then you need to have some sort of methodology for capturing the fact that this is ongoing, and having some sort of risk element as well to, is this a high risk model, or is it something that you can kind of live with? And there, it's simply important to really know the use. And then I think that in terms of risks, there's a couple of very hard to intuitively understand risks, in particular as it relates to ethics. So I think that and equality and that even ESG comes in as factor in the framework. So it is important to make sure that you invest in a couple of people who really understand guidance and risk, but then to have the ability to, in an easy way to understand, and make sure that all the employees get the proper training.
Thank you, Elizabeth, and thank you also, Stephanie, for both of your insights on these very interesting topics. Clearly, there's a lot for us to reflect on, for the audience to reflect on when it comes to operational resilience and AI regulation in the year ahead. So thank you.
Yeah, so that brings our webinar to an end. I'd like to thank all of our panelists for a really interesting discussion and really bringing to life the themes in our Outlook report.
Last but not least, we'd also like to thank our audience today. We're pleased that so many of you have showed up today. We have received quite a few questions. We've tried to kind of take them as we've gone along, but there are a couple that we haven't answered yet. So we will make sure to look at all your questions and follow up after this webinar. We will also follow up with an email that contains a recording for in case anyone wants to watch back the webinar. We'll also, of course, send you a link to the Regulatory Outlook report so that you can read it in your own time. With that, thank you everyone again, and have a really good day ahead.